Markus Helsing from Alpha Broking is joining us live from our Melbourne studio. Markus, good afternoon to you. Thanks very much for joining us. Now, maybe no surprises that we are seeing materials and energy at the bottom of the pack there today, given the pressure that we've seen in commodities overnight, and it's all been about the strength of that US dollar.
Well, that's right. Hi, Leanne. Look, to us, this whole move in the US dollar over the last 2 months has been a very, very dominating move. And in a way, it has been quite amazing that you've seen the likes of copper and oil actually rallying, while a US dollar was also rallying quite substantially. I mean, if you look at it, like US yen rallied 15 to 17% over the last 2 months and a bit. The Euro US fell from its sort of 110, 115 range to the 105 where we're currently. Look, to us, and also US, of course, sort of sidelined in the 74, 75 territory. As far as commodities are concerned, we think now that uncertainty is out the way with the Federal Reserve, they're a bit more hawkish than expected, from a 2-rate hike next year now towards a 3-rate hike or 3/4. That will bring the rate from the current 0.75 to 1.5%. That's the 90-day bill rate or euro-dollar rate in the US. Look, for us, on the big picture, not that much changes. I think I would probably prefer just mention US dollar first and foremost. This rally we had the last 2 months has been substantial. And with every major move, you do see, obviously quite naturally, people taking profits, and once a big move happened and reassess. So we believe it was a bit of a buy the rumor, sell the fact into the Federal Reserve meeting. We might have a bit of a settling down period. Certain commodities, such as oil, are a little bit collateral damage in this exercise. We believe maybe a $48, $50 level in West Texas Intermediate could be a tremendous base to reassess and look to re-enter or double up on current holdings in long oil as well as oil stocks. So I think a Woodside outlook has not changed. I mean, you look at your Exxons, you look at your Royal Dutches, your BPs, they're actually very bullish charts. And after a good run, it's normal to have a bit of a correction. Maybe you might have a correction into January before things get on with it. But we basically think oil story is still a $45 to $65 story and not what we've seen in the last 1.5 years.
And, of course, you know, Trumponomics and some of those policies have certainly been helping out, I suppose, the moves in the oil space. But we've been watching this ongoing slide in the gold price since Donald Trump's election victory, and that certainly has been hurting some of those gold miners.
Well, that's right. I mean, look, the reason why we do like gold and silver long term is because we just see what's happening to monetary policy over the last 7 years and the whole credit society of the last 20 years. Well, at some point, they will come to a certain judgment day. And with Trump being now in action, probably this whole thing might just simply be delayed by another year or two. But have no doubts, someday we will have to pay our bills of all the consumption we've done on credit. So that will come. But so in the moment when the US dollar is dominating, I think precious metals are on the back foot. I still strongly recommend use these lower prices to average yourself into the gold price as well as the gold stocks. But it is quite obvious that they are in the moment still under the pump and probably remain for a little bit longer. I think key levels to watch is the sort of $1,050 to $1,100 level in gold, US dollar an ounce price. We're currently around the $11.38 to $11.40 level, and silver $16 level is a good level, a key level, and of course anything between the $40 and $16 level. So any level around there, down there, should be looked at quite positively by investors in our view.
Let's talk iron ore, because it came off overnight. It's still hovering around that $80 a tonne mark. If we look at the forward curve, though, in iron ore, that is still putting a big question mark on the longer-term sustainability of those current spot prices, isn't it?
That's spot on. I mean, the backwardation, which is basically the differential between spot prices and forward prices, and the backwardation is the case when forward prices trade at a discount, in this case a large discount. I mean, January 17 to January 18, we're talking about $15 discount. So that's telling you that the long-term story in iron ore is questionable, and it's questionable in a way for the last $20 to $25 rallies. So in essence, the backwardation has slightly widened from your $10, $11, $12 to the $15 mark, telling us that spot prices around here are fantastic. Anything higher is a bonus. Most likely, we're going to see longer dated prices to basically telling us that the spot price will have a limitation from here onwards, and more likely than not, this time next year will be closer to $60 than to $80 a tonne.
What about for copper? I mean, has anything changed in your view? We know Dr. Copper, we talk about it, and often a bit of a bellwether for, for global growth and so forth. Do you still feel strongly about this in terms of it having that supportive sort of bullish feel for other commodities?
Very much so. I mean, copper had a major bear market for 3.5 years, troughed out for another year. So technically, the break that we had just last month. I mean, copper doesn't have a major break up just for the fun of it. There's a repositioning. As a matter of fact, inventories in London actually have gone up a little bit, and the copper price held steady, which does tell you there is a healthy demand side out there. So copper and Dr. Copper does tell us that overall for the global economy, things are still looking quite okay. So that gives you maybe an underlying support for broad industrial commodities, inclusive iron ore, inclusive your oils, because essentially it's telling us that most likely China is not doing too badly. With the Trumponomics and infrastructure spending that's expected, might be an underlying support. That's just basically adds on to the overall global demand. I mean, Australia doesn't really export that much commodities to the US. As a matter of fact, it's hardly anything. So it's really that it raises the overall demand structure and hence gives you price support. So copper to us looks bullish, and it has just started to break up. So that generally will be an underlying support also for the Aussie dollar. So rather than the Aussie dollar falling apart against, like most other currencies, against the US dollars, you'll probably find that the Aussie dollar will gain against the crosses, against the yen. It already broke up against the Swiss franc, euro, and so on, and probably hold reasonably well against the US dollar, probably between in a 72 to 75 range, rather than anything more dramatic than that. But copper to me is telling us a good story. So whoever is bearish out there should hold back, because that in a moment to us is telling us things are still pretty okay, and probably okay for the next 6 to 8 months.
All right, fantastic. Watch copper there. Marcus, we'll leave it there, but really do appreciate you joining us. Thank you so much.
Thanks, Leanne.